Understanding ratio analysis for microfinance operations. If you want to understand ratio analysis and its importance in the financial sector and that of its customers in terms of comparing financial statements, then you are in the right place. First, I encourage you to subscribe to this channel, Microfinance Arena, to receive more insightful and educational lessons and resources. Understanding ratio analysis is not rocket science. It is very easy to understand as it can be used to check various factors of a business, such as an increase or decline in the book's performance. Ratio analysis helps understand past indices and gives a reference for future decisions but cannot predict the future. The combination of different ratios gives a clear picture and true position of an MFI result. Also, it aids decision-making for better operation and improvement is independent of financial ratio analysis. Microfinance institutions use different methodologies to deliver their services. Hence, comparing ratios might not give the true picture of events. But for ratio use, it balances this operational difference. Let us begin with the table of contents. Here we would be looking at: what is a ratio? What is ratio analysis? Analyzing ratio. Importance of ratio analysis. Users of ratio analysis. Why ratio analysis? Uses of ratio analysis. Generating ratio analysis. Conclusion. Not to jump the gun, let us begin with understanding what a ratio is. Ratio measures the difference in relationship between values and other ways to make viable decisions. They are very significant for measuring a client's business performance over a period and are generated by dividing the numerator by the denominator, with the result being expressed as a percentage, a monetary value, days or numbers. Now, what is ratio analysis? Ratio analysis is a quantitative method used to assess a company's financial performance, efficiency, liquidity, profitability, and solvency by analyzing its financial statements. It is a key tool for investors, analysts, and business managers to evaluate the financial health of a firm. Analyzing ratios. While the ratio measures the difference in relationships between values and viable decisions, ratio analysis analyzes the financial performance. While it looks like they serve the same purpose, now understand that they have different functions and work relatively to complement results useful to both the customer's book of accounts and that of the microfinance bank. Importance of ratio analysis. Helps in financial decision-making by comparing different aspects of a company's performance. Provides insights into trends by analyzing past financial performance. Assists in industry comparison to see how a company performs relative to competitors. Aids in identifying strengths and weaknesses in financial management. Why ratio analysis? Why would anyone or an institution need a ratio or its analysis? We need to 1. Understand first that the results generated are because of the use of one or a combination of financial statements which are key elements in determining results. These results are then shown as metrics before being translated to verifiable results, either good or bad. Also, users need to determine a client's or business's net worth and its performance in order to make viable investment decision. These are the general reason why we need ratio analysis. Other reasons why ratio analysis is very important in our field of study are that it helps us make viable decisions on loan approvals. It helps us understand the type of risk involved in the client business. It interprets clients' business performance better. These are the main reasons why users would need ratio analysis. Now let's look at the users of ratio analysis and where they are from. 1. Clients. 2. Institutions. 3. Regulators. 4. General public. 5. Investors. Users are very interested in ratio analysis because it gives a whole lot of advantages. One of it is 1. Comparisons. Ratio analysis is used to compare a company's financial performance to similar firms in the industry to understand the company's position in the market. Obtaining financial ratios, such as price/earnings, from known competitors and comparing them to the company's ratios can help management identify market gaps and examine its competitive advantages, strengths, and weaknesses. The second thing it does is that it gives an advantage to what is called a trend line. Companies can also use ratios to see if there is a trend in financial performance. Established companies collect data from financial statements over many reporting periods to predict the direction of future financial performance and identify any expected financial turbulence that arises. Uses of ratio analysis. It helps us make viable decisions on loan approvals. It helps us understand the type of risk involved in the client business. It interprets the client's business performance better. It proffers how best to mitigate risk that may arise during course of business. It clarifies the relationship between previous reports. It helps to compare a company's financial performance to similar firms in the industry to understand the company's position in the market. It helps to understand basic lines and to see if there is a trend in financial performance. Or it helps us measure operational efficiency of a business and to determine the degree of efficiency in the management of assets and liabilities. Generating ratio analysis. You don't just wake up to a portion ratio. There are processes and procedures for achieving this. Generating ratios will take two forms, namely, generating ratio for clients' business, generating ratio for financial institutions. Let us discuss the first. Generating ratio for clients' business. In order to adequately assess a client's retail business to determine its net worth and make a decision on loan granting, a microfinance analyst is expected to understand the listed ratios below. Liquidity ratio, turnover ratio, debt ratio, profitability ratio, repayment capacity ratio. The above listed ratios are used to understand your customer's business and the rate at which it is making an impact. It is also important to note that the results generated from the ratios are a result of the use of one or a combination of financial statements, which are key elements in determining these results. Determining a client's net worth and performance would require use of the client's balance sheet and the profit and loss. As for the second, generating ratio for financial institutions. Microfinance banks' ratio indicators for portfolio analysis are measured in key areas, and when they are all combined, they give a clear perspective about the financial situation of the microfinance banks. The key area of ratio management is divided into four indicators, namely, asset and liability management ratio, profitability management ratio, portfolio management ratio, proficiency and productivity ratio. The results generated from the ratios are a result of the use of one or a combination of financial statements, which are key elements in determining these results. To adequately understand the performance of a microfinance institution's net worth and performance, it would require the use of the balance sheet and the profit and loss and the portfolio report. Before we start generating ratios, we need to understand the ratio analysis table. The ratio analysis table shows how ratios are examined with a combined use of both the balance sheet and profit and loss statement to learn about its liquidity, operational efficiency, turnover period, repayment terms, and profitability. It uses a combination of metrics to analyze a variety of financial data about a customer's book or company. In other words, we will understand the ratio analysis table better when we engage with the contents in the formula therein. Highlighted, we start with the liquidity ratio. This is the value of current assets divided by the value of current liabilities. These are both gotten from the balance sheet, and it shows the level of liquidity the client has in his business, which can cover short-term liabilities as they arise. The next is turnover ratio. This is the value of the cost of goods sold, gotten from the profit and loss, which is then divided by the value of the inventory obtained from the balance sheet. The formulas shown in A, B, and C are shown. A, it shows the portion of the inventory/stock that has been sold off already. B, to find out how many days it will take to sell off the stock. And C, the total days it would take to sell off the stock if an additional loan is given to the client to buy more stock to his business. We now move on to the debt ratio, where we analyze the value of debt to equity. This is the value of total liability divided by the value of equity. They are both extracted from the balance sheet. The debt ratio still has an arm where we determine an additional debt added to the current loan position. This is known as the future debt to equity ratio. This is the value of debt in addition to the proposed new loan obtained from the balance sheet. divided by equity also gotten from the balance sheet. Our next discussion is on the profitability ratio. It shows the value of profit obtained from the profit and loss statement, multiplied by 100 and divided by the total sales that were obtained from the profit and loss. Finally, here, we look at the repayment ratio. This is the monthly repayment installment value divided by the total disposable income. Both are derived from the profit and loss statement. The above ratio is used to make decisions on whether a customer is to have access to the loan applied for and the amount that can be availed. In order to get your ratio analysis well, the balance sheet, the profit and loss, and the portfolio report are very important tools. Let us look at this review question. 1. What is the debt ratio for a loan client with an outstanding loan balance of $120,000 and total equity of $2,700,000? 2. Mention the financial statements needed to generate ratios for a microclient. 3. Explain ratio analysis in relation to the assessment of a client's loan. 4. Mention and discuss the important ratios used in assessing a client's loan. 5. Debt to equity and future debt to equity are the same. Is this statement true? The above question focuses on a ratio analysis for a customer's business. Find time to work it out and see how well you understand what you have been taught here. Back to generating ratio analysis, we look at how to generate the ratios for a financial institution. Asset and liability management ratio. These ratios show the ability of an MFI to manage financial obligations in terms of loan disbursements and take care of its loan obligations to creditors. Profitability management ratio. These ratios show and summarize the MFI's overall performance level. It shows the profit/loss level and decides the self-sufficiency level of the MFI in order to cover its costs. Portfolio management ratio. They measure the loan portfolio quality of microfinance institutions, and most especially the loan outstanding in terms of risk exposure. Proficiency and productivity ratio. These ratios measure the rate and frequency at which a microfinance institution conducts its operations in terms of cost and its relation to output. To further understand the table, let us look at the ratio analysis table first, starting with the asset/liability management under the types. We will also be looking at 5 other metrics, namely the ratio. These look at what we would be measuring the ratios against. Under this, we have portfolio yield, portfolio to asset, current ratio, non-earning liquid asset, financial expenses, and debt to equity. Above each item, we have the source, formula, description, benchmark. Under the second type, we would be looking at profitability management. Under this, we will be looking at 4 other ratio metrics, namely return on average asset, return on average equity, operational self-sufficiency, and the net interest margin. Above each item, we have the source, formula, description, benchmark. Under the third type, we would be looking at portfolio management ratio. Under this, we have 4 other ratio metrics, namely portfolio at risk, write-off ratio, risk coverage, loans at risk. Above each item, we have the source, formula, description, benchmark. Under the fourth type, we have the efficiency/productivity management ratio. Under this, we have 6 other ratio metrics, namely average outstanding loan size, operating expenses ratio, cost per active borrower per loan officer, client retention rate, average deposit account. Above each item, we have the source, formula, description, benchmark. Microfinance ratio indicators for portfolio analysis are measured in key areas, and when they are all combined, they give a clear perspective about the financial situation of the MFB. In conclusion, if your ratio analysis table is unable to answer analytical questions such as these: 1. Will it help decision-making when comparing different aspects of the company's performance? 2. Will it provide insights into trends by analyzing past financial performance? 3. Will it assist in industry comparison to see how a company performs relative to of competitors? 4. Can it aid in identifying strengths and weaknesses in financial management? then it's a sure bet that you have the right tool to measure the performance of your business. But if it doesn't answer your needs, then you'll need other tools to progress. Understand these facts about ratio analysis. Ratio analysis helps understand past indices and gives a reference for future decisions, but it cannot predict the future. A combination of different ratios gives a clear picture and true position of an MFI result. Decision-making for better operation and improvement is independent of financial ratio analysis. Microfinance institutions use a different methodology to deliver their services. Hence, comparing ratios might not give the true picture of the event. Thank you for joining us on this topic, and we are sure believe you had a good understanding of how ratio analysis works. See you in our other course, and do remember to subscribe to Microfinance Arena for more content.